Market turbulence, tariffs, and the changing economic landscape have raised concerns, but what does it all mean to a SaaS founder? In this special episode, we sit down with a seasoned leader in banking and finance, Mark Verissimo, who's Lighter Capital's chairman and the former risk officer at Silicon Valley Bank. Drawing on decades of experience navigating economic cycles, Mark shares a boardroom perspective on today's shifting economic landscape, from rising tariffs to the ripple effects on SaaS founders and tech companies. Tune in for actionable insights on risk management, strategic planning, and what it takes to stay resilient in a volatile market. Welcome to Bootstrapped, the lighter side, the podcast for B2B startup founders wanting to achieve success without giving up ownership or control. This podcast is brought to you by Lighter Capital, the leader in founder-friendly financing for B2B SaaS companies. Learn more at lightercapital.com. Hi, Mark. Welcome.
Thank you.
I am very excited to talk about this timely topic with you. I know you do a lot of thinking on what's going on in this crazy market. So let's just get right into it. How does the Trump administration define fair trade under its new reciprocal tariff strategy? And can you explain the difference between tariffs used as a bargaining tool and tariffs used as a protective measure, and just what's going on today?
Yeah. Well, the Trump administration, it appears, and certainly that's in their comments, are looking at both dollar tariffs, but they're also looking at non-tariff protections that countries use. People ask, what's the difference? And I might come up with just a couple of examples. One would be if a Chinese company wants to sell in the US, it comes to the US, sets up a corporate entity, and starts selling. If a US corporation wants to go into China, they need to find a Chinese partner, and the Chinese partner needs to own 51% of the joint venture to be able to sell in China. And it also comes with it the IP, et cetera. And so it's a little more burdensome. In a country like India, there was one example I was recently heard about where Monsanto had gone into India. They spent about $1 billion developing a cotton seed that was resistant to worms. And before they got there, Indian farmers were paying, I think, 450 rupees an acre for their seed. And Monsanto charged them 1,400 rupees per acre, but the farmers got an incremental 5,000 rupees an acre in incremental income. So clearly, Monsanto took more money, but they also gave the farmers a lot more money. And they quickly got 90% market share or something. Then the government came in and said, well, Monsanto, you need to reduce the price down to 450 because that's fair. And Monsanto said, wait, we're giving them additional 5,000 incremental income.
Yeah.
And the government sued Monsanto, ended up getting the IP from Monsanto, and basically Monsanto left the country. So those are examples of pretty blatant non-tariff. Yeah. Others are more subtle. The EU has a lot of regulations regarding everything, and they use that skillfully to keep products out of the market. When the Trump administration came out with these tariffs, some people looked at the numbers and, geez, that doesn't make any sense. And what they're trying to do is force the countries to also look at their non-tariff restrictions and go after that. I think it's being used as a bargaining tool to try to get other countries to allow U.S. companies to operate, a little more freely in those countries. And by doing so, maybe bringing some back to the U.S., although we can get into it later. That's going to be a challenge. I do think it's bargaining. What this has highlighted to change the conversation and highlighted the conversation is the vulnerabilities the U.S. has strategically to some of our trading partners. For instance, China does most of the pharmaceuticals for the U.S. China has 90% of the rare earth processing that goes there. And just with this actions, I think they've slow walked our rare earths. And allegedly, I haven't got this confirmed, but they sort of went to South Korea and said, we're giving you rare earths. You can't sell to the US. So it's stepped from just trade to sort of geopolitical. So I think it's highlighted some of the fragility of our supply chains.
Is there evidence that tariffs in the past have really shifted the U.S. trade balance in a meaningful way? And do we have historical examples that show tariffs succeeding or backfiring as an economic strategy?
The one instance that people pull out is the Great Depression. Certainly what I learned in school and more the Keynesian economists will say that the trade barriers that went up around the world caused the Great Depression, or certainly deepened it. For many years, I thought that was true. There's been some pushback recently. I guess if you look at the Chicago School of Economics and Milton Friedman, he will say that, yeah, tariffs did have an impact, but he thought monetary policy was the bigger driver of the Great Depression. It's hard to say. It's just two schools of thought that are very, very different about that. You could argue that the Depression continued until World War II. I have a grandfather that told me, he was a farmer at the time, and said prices didn't improve until 1941 when we got in the war. So from 1929 to 1941, we just muddled around. There were some recent, some people took a look at a specific category that Trump did in 2007. I think it was washing machines, and looked at what happened there. And it didn't seem to bring any employment back, but it also didn't seem to affect pricing that much, ultimately, to the ultimate consumer. Now, part of that was, absorbing, the Chinese were absorbing on their side, and maybe the retailers were absorbing, some on the other. So that was a little mixed. And then the steel, certainly steel tariffs have gone on and off over history. And there's been, some argument whether it does much. Now, one question we do have today is that when you look at tariffs sort of in the 80s, 90s previously for the US, it was definitely labor arbitrage. China was much cheaper. Now India is much cheaper. But if you look at where we are now with both AI and automation, you could argue, well, there's not that much labor left in some of these processes anymore. So it's more capital. Can I build the factory efficiently and let it run?
Well, I mean, how realistic is it to expect that tariffs will bring manufacturing back to the U.S.?
I would say it's tough outside of strategically important areas. So we may argue we want to have more control of our pharmaceuticals. This was an article I read in the Wall Street Journal a while ago, but if you looked at our pharmaceutical industry, I think it was Puerto Rico that had special tax advantages for doing business there. So pharmaceutical companies set up in Puerto Rico. And then in the 1990s, the Clinton administration got rid of that. And then you saw it all head over to China. I would say we may want to look at that and say there's a few areas, pharmaceuticals we won, rare minerals, maybe another one, and then maybe semiconductors that the U.S. would like to bring more of the manufacturing. And there I would not, simply just pour government money in there. I'd say, okay, how do I make sure that the both regulatory and access to capital, et cetera, is there for private companies to come in and do what they need to do. But I think across the board, it's a little more challenging to see much manufacturing come back. Because even the manufacturing that come back, I think will be highly automated. So it's not like you're talking millions of jobs coming back. It'll be thousands, certainly probably higher paying than your McDonald's worker, but it's not going to be huge.
We talked a little bit about how that would affect domestic employment. What I'm hearing from you is you think not much, probably, in terms of how will tariffs affect domestic employment. But what about inflation?
Boy, that's a $64,000 question, because if you looked at Trump's tariffs during his first administration, people did say there's going to be inflation. But when you looked at the inflationary numbers, they didn't seem to move that much. Mm-hmm. And then Biden actually kept those in place. And again, until COVID and, dropping, helicopter money, you didn't see much inflation. So, some people will say, well, the sellers will absorb some of it to keep market share. The retailers may absorb some of it. So how much actually, I heard one number that maybe 50% of it gets down to the consumer. that they'll see the effect there. But still, that's not inflation going down. That's still inflation going up. The question will be, if they do come in place and there's retaliation, how long does that last for? Because I think everybody's looking at, if you look at the GDP numbers today, it came out slightly negative, which actually, the day before I was listening to some economists from one of the big investment banks thought it was going to be a negative 1.5%. Because of this huge influx of imports.
Right.
Ended up being, 0.3%, which if you pull that out, then the growth is about 3%, which is generally what it was in the fourth quarter. It's hard to see how it wouldn't affect inflation. But then again, if this is a bargaining tool and you're trying to get to a place, do these tariffs sort of come down low? I don't think they'll go away, but come down to a much lower level when then the consumer doesn't really look at it.
Yeah. So at Lighter Capital, we provide non-dilutive financing mostly to business SaaS companies, to technology companies, and mostly anywhere from minimum of $200,000 a year in revenue up to, tens of millions. Basically, we fund small businesses. Our small businesses customer bases are very wide, right? From selling to government, selling to education, selling to other small businesses, selling to pharma. So we don't really focus on a specific vertical. You are our chair. How would you advise, and also the head of our investment committee, how would you advise Lighter to adjust its underwriting strategy in a time like this, or should we adjust it at all?
Well, I think going into any period of turmoil, it seemed like most of my business career has been in turmoil.
Yeah.
You need to figure out what is causing it, and then take a look at your clients, potential clients, the marketplace, and say, who's getting hurt and who's taking advantage of it. And you can look at some of this and say, yeah, multinationals and their supply chains, it's causing some reworking there. But again, our companies are smaller. I look at Kelly Evans. She's one of the CNBC moderators, and she puts out a newsletter a couple times a week. And she talked about the tariffs and the impact. And she talked to one of the CEOs, one of the big regional banks. And he said, hey, we're not seeing any change right now. And this would be recent, within the last week. So we're seeing still good loan demand, people going forward, doing things. And she said, actually, the small business environment, they were more bullish than the big multinationals. So they were still feeling pretty good about things. But like anything else, you take a look at, okay, what product are they selling? And who are they selling it to? Are the entities they're selling it to being hurt, or does it matter? So I would not pull back. I would still be on, sort of a forward motion. If I was a small business looking for is it bringing up any opportunities for me, or am I just steady as I go? And then for lenders, it's more taking a look at those companies and saying, some companies will probably just glide through this. Now the question is there a recession in our future? That, to me, is another situation where you have to look at closely and see who's going to get hurt by recession. I remember one time saying, we've accurately predicted 20 of the last 3 recessions. I mean, people constantly been talking about recession, and hasn't come yet.
Right.
It's, you would seem it's long in the tooth, but other people say, well, they don't die of time. There's usually inventory buildup. I mean, there's something that's driving a big pullback. But, I think a lot of people are just right now is the Trump administration playing 3D chess, or are they playing lousy checkers?
Yeah.
And that is a big divide right now as to what people think. And administration is really trying to change the status quo. And whenever you're trying to change the status quo, you're always going to get pushback from various entities. That some people have made a lot of money the way things are. And so they want to protect that. But it's also, I think, hurt the country in ways. So at least we're talking about it.
So to summarize, there's not really advice you to give right now other than sort of maybe hold steady, look at companies that could be directly affected by this, but we shouldn't be pulling back the way we were, say, at the end of 22 when it was quite uncertain what was happening in the market, and we shouldn't be taking those types of actions now. This is more a business as usual with a special lens on how tariffs could affect specific companies we're providing capital to.
Yeah. I think when you look at what they're trying to do, there's a couple of threads of thought. One thread is in the 50s and 60s, we were very generous with our tariff policies because we were the only industrial complex that wasn't hit by war. And we wanted to build up other countries. And a lot of that was, we didn't want them to be communists, whatever. So we did whatever we could to it. So the tariffs were negative to us. And we accepted that. And we were able to power through it because we had the only industrial complex that was untouched by war. Fast forward 50 years, things have changed. We've talked about tariffs. There's been discussions before, but nothing much has changed with what's going on. So there's just a general issue with it. The secondary one is China specifically. And China joined the WTO in 2000. They joined as a developing country. Well, what does that mean? Well, developing country means I can put tariffs on, I can subsidize industries, et cetera, without having the WTO come after me. Now, in 2000, you can argue, that kind of made sense. They weren't a fully developed country. But fast forward 25 years, they're considered a peer to the US. So it's hard to see them as a developing country, yet they can still put tariffs on, they can still subsidize industries. And somebody pointed out there's an interesting speech that the predecessor to Xi Jinping in 2003 said, he put up 10 boxes and he said, these are the 10 key areas that will drive future economic growth. We are going to get national champions in all of those, and we're going to dominate those. Fast forward to today, Xi Jinping kept that part of the philosophy, and they dominate, rare minerals. They dominate pharmaceuticals. Just go down the line. They have successfully dominated these things. And so for the US, again, it's a question of, there's historical, why we're here where we're at. And it doesn't seem like it will be a quick around China, quick and easy. Now, the question is whether the EU and other partners, we can come to a faster understanding. And the question is, could it be done differently? I would tend to believe some of those people more if they had been suggesting alternatives and pushing to have change before this. Mm-hmm. I'm more cynical when they have, sort of in the spectators looking down saying, well, you can do it better. Well, you were in power. Why didn't you do it differently? Right. So we're kind of, at least for the time being, stuck with this pattern from the administration.
I think we probably should have a talk like this again in 3 months or maybe in 3 weeks, because it all seems changed. Or in 3 days. Who knows? This seems to be really fluid, but it'll be interesting to see what happens after the 90-day reprieve is up in July on these tariffs and see where we go there.
If you look at the market, you look at the 10-year treasuries, they tend to be, they haven't come back all the way, but they've certainly rallied. Either they know a lot more than I do, or they're wishing and hoping like the rest of us as to what's going to happen.
All right. Well, thank you so much, Mark.
Thank you, Melissa.
We hope you enjoyed this episode of Bootstrapped, the Lighter Side. To receive future episodes, subscribe using your favorite podcast platform. And if you enjoy this show, please share it with other fellow founders and entrepreneurs. For more insights, helpful tips, and to learn more about founder-friendly financing options, visit us at lightercapital.com. That's LIGHTERCAPITAL.com.